Hi everyone and welcome to Investing in Canada. So this course is about making your investments in the most efficient way. So today's topic is FIRE. So what is FIRE? FIRE is financial independence and retire early. So this is a very exciting topic that we are going to talk about. Okay, so if you're new, this whole course is available on Udemy. The course is Investing in Canada, so the links are in the description, so click on it and check out the whole course. Also, some free videos are available on our YouTube channel, so EduFin Wizard. So if you're new here, please subscribe to the channel for more videos like this. Also like and comment so that it helps the algorithm to reach more and more people. So what is FIRE principle? So FIRE principle is very easy. So our objective in FIRE is to retire early and have financial independence. So how do we achieve that? So we cut down expenses, we review where we are spending, and we cut down our expenses to bare necessities. Then we save aggressively, we save as much as we can. We invest in a diversified portfolio. We accumulate the objective is to accumulate 25 times our yearly expenses. So if your yearly expenses are $50,000, then we achieve 25 times of that is $1.25 million, right? That will be our goal. So if your expenses are $100,000 a year, then our objective is to achieve $2.5 million, 25 times our yearly expenses. So why do we do that? So that we can have financial independence. The rule is, if you accumulate 25 times your yearly expenses, and that is your savings, that is your investments, so you can take 4% out of that every year without depleting it, without running out of money. So if you can achieve $2.5 million and you want $100,000, so that is 4% of 2.5 million is 100,000. You can withdraw every year without running out of money. So why do we want to do that? So that even if you're working after financial independence, so the objective is to work if you want to, not because you have to. So this gives stability, this gives like stress-free life. So this is the FIRE principle. It's a very popular principle. There is a big movement around it, like social movement around it. So a lot of people follow this. A lot of people have already achieved their retirement using this principle. So let's boil down this principle in a bit detail. Let's unpack it. So what do we do in FIRE principles? So step number one is we review our spending. So review spending means look at all the subscriptions, because you will be amazed what kind of things you have subscribed to. So it could be like some online subscription or newsletter you were not even reading, right? So it could be some like video subscription that you're not watching. So you will be amazed of how much we spend in subscriptions. So review all your subscriptions that you currently have and delete every subscription, right? And start over start again, start fresh. So that what happens when you delete all the subscriptions, you will only subscribe to things that you actually need, not all the things that you already have. So step number one, delete all the subscriptions you have. Step number two, start fresh, right? Only subscribe to things that you actually need. Okay, then focus on your shopping habits, right? So shopping habits can be divided into need and wants. So needs will be like necessities, like groceries. Then let's say Netflix could be a need, because you need some entertainment also. So all those things are need. So what do we do in needs? We find cheaper ways to buy things in the FIRE principle. So let's say grocery bills, try to use a lot of coupons if possible. Try to shop in like Costco and stuff, so that the grocery bills are lower. Try to find deals. Okay, and when you have wants, like in shopping terms, wants are everything, like let's say buying clothes, right? Not the necessary clothes, but like buying expensive clothes or expensive stuff or decorative items. So those are all wants in shopping. So what do we do with wants? So try to formulate your wants in this thing. How much it will contribute to your happiness? So buying something, how much will it contribute to your happiness, and for how long? So if you can formulate your wants in this, so let's say I want to buy an expensive jacket, so how much happiness will it bring me and for how long? If it is only going to bring me happiness for, let's say, 2 days, right, after that it's going to just lie in my closet and I'm never going to wear it, then it doesn't make sense to spend on it, right? But if it is a vacation with family, that is going to bring me happiness for months, because my family is going to be happy, my kids are going to be happy, my wife is going to be happy, and those things will create memories for me, then I would spend on it. So it's a simple mechanism. Needs, try to find deals on them, try to buy it cheaper, and if it is wants, try to cut down on those wants and try to formulate wants, try to spend on wants that actually bring you happiness. Then you can also follow minimalism. So minimalism is a technique of focusing on friends and family rather than buying things. So trying to have bare necessities and focusing your time and your spending on friends and family, creating a budget and reviewing the process of buying stuff. Okay, making it hard for you to buy, so sleeping on things, right, having a friend or family member to discuss before buying, all those things help you to sticking to a budget. So this is point number 1, cutting expenses, and we try to cut down expenses aggressively. Then the second part is, when we cut down expenses, right, a lot, we'll have a lot of savings. So what do you do in savings? So first principle is pay yourself first, that is save before you spend. Because if you do not do this, if you spend before you save, you will never have enough savings. So objective is to have targets of how much dollar amount you want to save every month, and once you save that, then whatever is remaining you spend. Okay, have a saving goals, that is very important. Minimum 10% of your paycheck should be saved, like 10% of take home salary should be saved. You can always target higher. FIRE is where people are saving 50% to 70% of their take home pays. That is very aggressive, that eventually you will get there, but a baseline to start from is somewhere around 10%. Then before you start investing that money, always have an emergency fund. So emergency fund is like 6 to 7 months of expenses, right, in liquid cash. Always have that on hand, because you don't know what goes wrong. Your car might break down, your family might need some medical expenses. So all those things are very important to have before you start investing. And have an insurance strategy, so cover yourself in all things possible that can go wrong. Insurance is a cheap way of handling emergencies. So have a medical insurance, have a disability insurance, have a life insurance, have a car insurance. So all those things are very important. Then save in the right accounts. So saving is important, but saving in the right account is also important. So which accounts to use? Do we want to save in tax-free savings account? Do we want to save in RRSPs? Tax-free savings account, your investments grow tax-free. Retirement account, right, RRSPs, you get a tax deduction, right, your taxes go down. RESPs, you get government grants for your children to achieve education. First house savings account, useful if you're trying to buy your first house. All these accounts I've covered in a previous video, so please watch those videos if you're interested in it. Then this is a psychological trick. Reward yourself for achieving your goal every month. So let's say you're achieving your saving goal. So your saving goal is saving $200 every month. And if you achieve that, then reward yourself. Go out for a coffee, right? Go out into a park, right? Talk to a friend about it. Talk to your partner about it. This acts like, this is like social confirmation. So sticking to your savings plan is a social thing. If we can make each other accountable, make our friends accountable, it is possible to achieve it more frequently, like it is possible to achieve it more easily. And finally, do it together. If you are a family, if you have a partner, like have them buying into this idea too, because it's very important that your partner has a buy-in, like in whatever you are doing. You can keep each other accountable, and also like as a family you're moving in the right direction together. Then once you have started accumulating savings, you have your emergency taken care of, emergency fund, you have your insurance like to handle all the risk, then and you're finally at that stage where you are accumulating money towards your investments. Now where to invest? You can invest in real assets. There is certainly an advantage of buying your first house, right, first home, because in Canada you have principal tax deduction, so there is no capital gain tax on primary residence, right? Plus when you're renting, you're paying someone else's mortgage. When you buy your own house, you're paying your own mortgage, so you're building home equity in it. And like especially housing is one of the primary assets that Canadians have, so it's a great advantage to have your first house. There are pros and cons about having your second investment in real estate. There is a video that already covers that, so if you're interested, watch it. But first home everyone should have, like primary residence everyone should have their own. Like renting is not that efficient because you're paying someone else's mortgage. If you have your home, like rent out the spare capacity, because it is a good revenue stream for you. You can have a student, you can have Airbnbs, you can, if you have a garage or parking space that you can rent, think about all those things, because that gives you a good passive income. Then you can also invest in financial assets. So two important things: use correct accounts to invest, like use tax-free savings account, RRSPs or RESPs wherever it is relevant. So using correct account is very important, because imagine if you have $2.5 million like by the time you retire in your tax-free savings account, then if it is in TFSA, it's completely tax-free. You can make withdrawals from it, doesn't impact your income at all, right? It's completely tax-free. So there are advantages to using the correct account a lot. So we have covered videos about TFSA, RRSP, RESP in some previous videos, so watch those videos if you haven't done it. Then also diversify your investment. So I have a technique of core and satellite. So core is 85% of all my investments are in my core portfolio. Core portfolio for me, it's only index funds, diversified index funds. That is what I buy in core portfolio. I do not take stock specific risk, I do not take asset specific risk there. I just invest in index funds, right? Stocks and bond index funds. Then some 15% of my money I also take some kind of risk in it, trying to outperform the market. So that is my satellite portfolio. I have a lot of covered call ETFs, I have like leveraged ETFs in it, right? Some stock investments too. So I have discussed this in detail in ETF video, so if you haven't watched it yet, so there is a special video that helps you to design your own investment plan. Okay, so divide your investments once again in real assets and financial assets. Use the correct account, that's going to be extremely important. Then create an investment plan. So how do you create an investment plan? So I have a calculator that can help you a lot. So example, I'm going to share this in the description. So this is a Excel sheet that is kind of a calculator. So what can you do? You can put your yearly expenses in it. So let's say we are putting down $20,000. We have, okay, $40,000 is our yearly expenses. Okay, so it will give you your FIRE number. So if you want $40,000, if your expenses are $40,000 per year, then your FIRE number is $1 million. Then you put in how many years you have to retire. So how many years you want to retire. So let's say I want to retire in 25 years. So it will give you how much monthly savings is needed. Okay, one more thing, you have to also put in current investment. So let's say, once again, I have $40,000 of yearly expenses. So my FIRE number is $1 million. I have 25 years to retire and my current investments are zero. So effectively I need $1,200 of monthly investments to retire. And once I retire, I can withdraw $3,333 from my investment portfolio without running out. Okay, this is the FIRE calculator. So you can put your own numbers. So let's say I put in $100,000. So my FIRE number will be 2.5 million. I have 35 years to retire, let's say. Okay, and I have, let's say, $50,000 in my current investments. So I would need $1,000 of monthly investments to retire. Once I retire, I can withdraw $8,300 of monthly pension from my investments. So the whole 25 times and 4% idea is, if you accumulate 25 times your yearly expenses and withdraw 4% of that FIRE number, you shouldn't run out of money in your retirement. Okay, so use this Google sheet, like play around with it. I'm going to share it in the description. So what are benefits of achieving this FIRE number? So benefits are, it creates less stress because you have a big corpus to fall back on, right? Then lot of people, even after achieving their FIRE number, they do not quit their jobs. So because then you have the flexibility of working if you want to work, right? If you love your work, you can still keep on working there, not because you have to, because you want to. So this is a great principle. It brings financial independence. It leads to better relationship because as a family you are working towards something. So it builds trust, it builds security, and those are important stuff in any relationship, security and trust. Also, when you achieve a big corpus, there is more time for hobbies, right? Because you're less stressed. You can cut down on work if you want to, and have work on your hobbies and stuff. And also, a lot of people who have achieved their FIRE number, they give back to the society because you have the flexibility to do that. Okay, so there are a lot of benefits in achieving financial independence. So if you like videos like this, please subscribe our channel EduFin Wizard. Subscribe, like and comment. If you are interested in the whole course Investing in Canada, so please check out the Udemy link that is shared in the video. Thank you very much for your time. I will see you in the next video.